Hello, this is Larry Tintorelli. I'm a full-time technical trader and the editor and publisher of the Blue Chip Daily Trend Report with a blog and video titled Our 6 Best Ideas to Manage Volatility. And the reason that I put this blog and video together is obviously the markets have been very volatile over the past month or two. And I talked to a lot of people online and in my personal network, and a lot of them are having some difficulty still managing the day-to-day volatility, the day-to-day news flow. And what I wanted to do is put together some of my best ideas which might help. So we'll get started with the blog and the video. I'm going to touch on the 6 best ideas. We're going to take a look at a few charts and we'll go through the process. And then I'll just touch base on the disclaimer real quick, which says that everything in the video is for informational purposes only. It's not a recommendation to buy or sell any securities, and past performance is no guarantee of future results. So we'll get started with the blog and the video, and you can read through the blog at your own leisure, but there's just a couple. I'm going to touch base on a couple of the key points, and then you can read through this at your convenience. So the first thing, obviously, the way that I deal with volatility from a mental standpoint, and this is something that I think everyone should really focus on, is you have to know your time frame. So what happens is a lot of times what I hear is someone that has an intermediate to a longer term time frame, but they get caught up in very short term things like the overnight futures market, what somebody on TV has to say about a stock or a market, and things like that. And basically what happens is if someone has a very short-term time frame, that's fine. They want to focus on short-term data. But if somebody has an intermediate to longer-term time frame like myself, either as a trader or an investor, then it pays to really not get caught up too much in the day-to-day, what brokerage firm upgrades a stock or not, what somebody on TV says about a stock, or what the overnight futures markets are doing at 7 p.m. Another thing, we don't need to look at if we're longer term positioned. It doesn't really matter what the 5-minute chart says or what somebody on social media says about it. Now, the other thing is, along with time frame, is understanding risk tolerance. And what happens is a lot of us think that we are much more risk tolerant than we really are. And when the markets are going up, we think that we can handle a lot of volatility. And then what happens is as soon as they start to pull back, often they pull back faster. And then we realize that we're not as risk averse as we think we are. So number 2, one of the best risk management tools that I know is to manage the cash balances. So what happens is the cash balance, not only is it a volatility buffer in the account, but it's also really a great mental buffer. So here's what I mean. If somebody's got 100% of their money in stocks and the stock market, then they might be a lot more susceptible to short-term volatility than someone that's got, say, 20% or 30% or 40%. So what works best for me is in highly volatile markets, especially like what we've had recently, is I'll drastically increase my cash balances. So instead of being, let's say, 80 to 100% invested, which I might be in a low volatility uptrend, I could be anywhere from 0, 30, 40, 50% invested. So I found if we focus on the cash balances, the getting it dialed in right to where we don't worry so much about the volatility, experienced traders call it selling down to the sleeping point. And what that basically means is that if your exposure keeps you from sleeping, then if you keep selling it down until you're no longer worried about it, we can generally make better decisions. Number 3, stop losses. The second best risk management tool that I know of is stop losses. So basically the way that I do it is when I get a signal, I size up my trade, I take the position, I put the stop in, and then I don't worry about it. And what that allows me to do is automate my process, remove the emotions, or reduce the emotions, I should say, because we can't fully remove the emotions. But to give you an idea, here's a look at a chart for Service Now. So this is a position that I'm in currently, and I took the position on April the 20th. So you can see it's this bar right here. I took it at 301. It went up to 308 the same day, and then the next day it traded all the way down to 281. Now, when I took the trade, I took my position and I set my stop right away. So I used a 15% stop, which is my standard stop for a stock with this volatility rating. So I set my stop, I took my trade, and then I let it alone. And then right after I took the trade, it went up, everything looked great. And then the very next day, it went down and tested 281. So it was down about 7% the next day. Now, because I had a stop and because I had my position size correctly, I knew that I took my position here. Here was my stop. There was nothing else for me to do. And while I didn't really like seeing it go down 6 or 7% the next day, I knew that my stop was here. There was no temptation for me to sell it, cut the position, try to buy it back later. And then what's happened, obviously, is the stock's rebounded higher. Recently tested 357. It's at 339 right now. So I'm up about 12% in the position that started off down 7%. And the only reason I'm still there is because I knew that I had my stop loss to get me out of the trade if it went against me. Number 4, I assume that every position that I have will get stopped out. And when people hear that, they say, well, why would you, what kind of a trader assumes that? Well, it's just reality. And I got this initially. So in the Market Wizards book, the original one, Paul Tudor Jones said, every day I assume every position I have is wrong. So I thought about that for a second. And I said, if one of the greatest traders ever walks in every day and assumes that every position he has is wrong, then maybe that's something that I should consider as well. So what I do, I assume when I take a trade, when I take a position, I assume 2 things. Number 1, I assume it can be a very big winner based on my process and how I manage my positions. And number 2, I assume that any position can get stopped out at any time for any reason. So once we accept that and we realize that that's just a part of the business and we don't take it personally, it's a lot easier to handle the volatility. So when I sit down and I look at the screen and everything is down for the day, I've already mentally prepared myself in my head for any position to get stopped out, every position to get stopped out. So when it happens, it doesn't bother me. It's not great, but it just is what it is. And we know that when we put money at risk, that they could get stopped out. So knowing that every position can get stopped out at any time helps me quite a bit deal with the mental volatility. And then another thing, James Simons is regarded as one of the greatest traders ever based on his returns. And in the book about him, it said he has a 50.75% win rate. So his fund is right a little bit over half the time. George Soros, who's one of the greats, is said to have a less than 40% win rate. So if these are the best of the best traders and they get it right 40 or 50% of the time, then there's no reason why we should take it personally when we have trades get stopped out or go against us. Number 5, another great risk management tool, move up the stops, scale partial gains to reduce the open risk. And what I mean, and we'll take a look at a current position. So this is a position that I'm in Netflix. So in a nutshell, I took the position at 369. Now I set my stop down here right under 315. The trade started to work right away. And once it was up 20%, I reduced some of the position. I took some gains off the table and I moved up the stop. So basically what this does is 2 things. By moving up the stop, what it does is it reduces my open risk. So if my stop, and these are just hypothetical numbers, but if I started with a 12% stop and then I cut it to 6%, then ideally I've reduced the open risk by half. And then what happens is when the trade moved up 20%, and then I took some of it off the table, what that's allowed me to do is, number 1, book some gains. And number 2, because it reduces my open risk, I've got less volatility here. So by reducing some of the gains at 20% and by raising the stops, I've taken 2 measures here to reduce some of the volatility and lock in some profit. Now, by using a predefined number, so I used 20% here. Some traders and investors might want to take their profits a little quicker. Maybe they set it at 10%, 15%, whatever the number is. Now I'm still in most of this position. I only booked a piece of it, took a piece of it off the table. I'm still in most of the position, but by pre-planning the trade and saying, okay, here's my stop, here's my scale point. When it hits that, we dial back a piece, we raise the stop. What it helps to do is put more of a structure into the process so that it's not just a day by day trying to figure it out. And then the last thing, number 6, tune out the news, predictions and opinions. And what I mean by this is the media does a great job, but their job is 24 hours a day, 365 days a year. They need to get us to click onto their article, click onto their website, or watch what they're saying on TV. And the way that they have to do that is through sensationalism. If they just came on TV and said, everything looks about the same, the markets are pretty low volatility, and let's just stay with what's working right now, then nobody would listen. So instead, they need to write articles why, the market's going to go down 30%, or why this stock might double tomorrow, or, why the next recession is right around the corner. And any of that might be true, or it might not be factual. But at the end of the day, more information does not equal better results. It's usually the opposite way around. More information usually equals less results. And once again, we'll go back to James Simons and George Soros. If they've got a 50% or so win rate, if they can't predict markets, and they're the best of the best, if they can't predict anything consistently, what makes us think that anyone on social media or TV can do that either? So in summary, we want to devote serious time and effort to really understand timeframes, objectives, and risk tolerance levels, use cash balances as a mental and financial buffer, learn to accept that minor losses are part of any professional and trading program, use stop losses, don't take them personally, actively manage risk by moving up stops and partially scaling winners, and then tune out short-term news like the futures markets and outside opinions. So those are just some of my best ideas. I appreciate you listening. My website is Blue Chip Daily Trend Report. It's bluechipdaily.com. If you go onto the Join Now page, you can see we've got our daily members benefits. We've got a premium members only Twitter feed where I post real-time intraday market commentary, chart analysis, and our best technical ideas, as well as our best risk management. Then we've got our weekly updates as well, and we are actively accepting new subscribers. So I appreciate your time, and I hope to see you online shortly.